Taxes don't go away in retirement. In fact, for most people, they get more complicated. And if you're not careful, you could easily pay tens of thousands more than you should. Sometimes even 6 figures more over the course of retirement. So in today's video, I'm going to walk you through the 6 biggest tax mistakes I see retirees make, and most importantly, how you can avoid them. I'm Jordan Sester, a certified financial planner and founder of the Retirement Co. On this channel, I break down taxes, Social Security, income strategies, and more in plain English so you don't have to guess your way through retirement. If that sounds helpful, hit subscribe so you don't miss future videos. And tell me in the comments, which one do you worry about more? Running out of money or paying too much in taxes? Mistake number 1, ignoring taxes on your Social Security. A lot of folks are surprised, even angry, when they first learn that Social Security can be taxable. But yes, up to 85% of your Social Security benefit may be subject to federal tax depending on your income. Here's the formula. The IRS looks at what they call provisional income. That's your adjusted gross income plus half of your Social Security plus any tax-free interest like muni bonds. If you're single and your provisional income is above $25,000 or married and your income is above $32,000, that's when your Social Security starts to become taxable. And at higher levels, up to 85% of your benefit could be taxed. Let me walk you through a very simple example. Let's say that you're a couple with $40,000 of Social Security benefits. On top of that, you withdraw $40,000 from your IRA. You might think, well, that's $40,000 of taxable income from my IRA. But because of the formula, another $34,000 of your Social Security gets pulled into that calculation. So instead of $40,000, the IRS sees $74,000 of taxable income. That's called the Social Security tax torpedo, and it's one of the biggest gotchas a retiree faces. Now, I had a couple in Maryland meet for a planning session, and they were living comfortably on Social Security and IRA withdrawals, about $80,000 a year. They thought they were in the 12% tax bracket, but after we ran the numbers, they were actually paying effective rates of closer to 20%. They couldn't believe it. And here's the kicker. With just a few tweaks, like timing their IRA withdrawals differently, we were able to cut their taxes by $5,000 in the first year. That's the difference between knowing the rules and getting blindsided by them. Do you know if your Social Security will be taxable? Drop a yes or no in the comments and let me know. Mistake number 2, bad withdrawal sequencing. The second mistake is taking money out of your accounts in the wrong order. Most retirees just wing it. One year they pull from their IRA, the next year they sell some stock. It feels flexible, but often it triggers unnecessary taxes. Here's a general rule of thumb. Spend from your taxable accounts first, your brokerage account. Then from tax deferred accounts like IRAs, 401ks, TSPs, and finally leave Roth IRAs for last. Why? Because taxable accounts often generate long-term capital gains, which are taxed at lower rates. IRAs are often taxed at ordinary rates, and Roth IRAs, you guessed it, are completely tax-free. But here's the nuance. If you retire early, call it 62, and you haven't yet started Social Security, you may have a window of very low income years. Those years are golden for doing Roth conversions. So sometimes it actually makes sense to tap your IRA early when you're in a low bracket rather than waiting until RMDs force your hand at age 73. Here's an example. I had a client who retired at 63 with $1.2 million in their IRA. He didn't touch it for 10 years because he wanted it to grow. And when the RMDs kicked in, his first RMD was $50,000 on top of his Social Security. It shoved him into the 24% bracket and made 85% of his Social Security taxable. It even bumped up his Medicare premiums. If he had strategically drawn $30,000 to $40,000 a year and converted it into a Roth while at the 12% bracket, he could have saved himself hundreds of thousands of dollars in taxes. So let me ask you, do you know which account you'll pull from first in retirement? Type IRA, brokerage, or Roth in the comments. The third mistake is ignoring RMDs, or required minimum distributions. Starting at age 73, you're forced to start pulling money out of these IRAs and 401ks. And if you don't, the penalty is brutal. 25% of what you should have withdrawn. But even if you avoid the penalty, they can create another problem, bracket creep. Let's say that you have $1 million in an IRA. At 73, your first RMD might be around $40,000. That counts as ordinary income. And that income can push you into a higher tax bracket, trigger more of your Social Security to be taxable. It can even raise your Medicare premiums through IRMA surcharges. I had a couple in Kansas with about $1.5 million in retirement accounts, and they figured, we'll just let it grow and live on the dividends and wait. But when RMDs kicked in, they were forced to withdraw over $60,000. That 1 year pushed them into the 24% bracket and taxed 85% of their Social Security, which effectively raised their Medicare premium by $2,000. That's what happens when you don't plan ahead. Have you calculated your future RMDs? If yes, type RMD ready in the comments. If no, just type no idea. The fourth mistake is skipping Roth conversions. Most people shy away because they don't want to pay taxes today, but the reality is simple. You're either going to pay taxes now or you're going to pay them later. And usually later costs more. Here's why. Tax rates today are historically low. The 12% bracket, the 22% bracket, these are lower than most retirees realize. And that's because Congress just passed those to avoid rates going back up. Now, a Roth conversion means you can take money from your traditional and move it into a Roth, pay the tax today, and then that grows tax-free forever. No RMDs, no taxes for you, no taxes for your kids if they inherit your money. Here's an example. Let's say you convert $50,000 at the age of 63. At a 12% tax rate, that's a $6,000 tax bill. If you wait until RMDs hit and you're in a 22% bracket, that same $50,000 withdrawal costs you $11,000 in taxes. So would you rather pay $6,000 now or $11,000 later? That's the Roth advantage. Let me ask you, have you ever done or thought about doing a Roth conversion? Drop yes or no in the comments and let me know. The fifth mistake is forgetting about state taxes. Federal taxes, they get all the attention, but what your state can quietly take is a big bite out of your retirement. Some states, like Texas and Florida, they have no retirement income tax at all. Others, like Kansas, they do tax retirement income. And some states are quirky. They tax pensions, but not Social Security. Or they exempt certain types of IRA income. I had a client move from Nebraska to Missouri in retirement. They thought it was just a lifestyle move. But the hidden benefit? Missouri doesn't tax Social Security at all. That move alone saved them $3,000 a year in taxes. So if you're considering a move in retirement, don't just look at the weather and the housing. Check the tax map too. If you could live anywhere in retirement, purely for tax purposes, where would you go? Type your answer in the comments and let me know. The sixth mistake is the biggest one of all. Not having a tax plan that looks ahead. Too many retirees just do taxes every April. That's not planning. That's reporting. Planning is different. Planning means asking questions like, should I convert to a Roth this year while I'm in a low tax bracket? Should I take bigger withdrawals early before Social Security and RMDs start? How do I avoid Medicare surcharges by managing my income? What happens if my spouse outlives me and has to file as a single taxpayer in a higher bracket? I've seen retirees save 6 figures in lifetime taxes by planning ahead. And I've seen others pay 6 figures simply because they didn't need to. The difference isn't luck. It's having a plan. So let's recap the 6 big tax mistakes retirees make. Number 1, ignoring taxes on Social Security. 2, taking withdrawals in the wrong order. 3, ignoring RMDs until it's too late. 4 is skipping Roth conversions. 5 is forgetting about your state taxes. And 6 is not having a multi-year plan. Which one of these do you think could hit you the hardest? Drop your answer in the comments. I read every single one and I would love to know. If this video was helpful, hit the like button so YouTube shares it with more retirees just like you. And if you'd like a personalized retirement tax strategy, download my free retirement tax checklist in the description or the comments, or you can schedule a call and I'll walk through your numbers personally with you. And don't miss my next video, how to save thousands in taxes in retirement. You can click and watch it, and I'll see you there.